What is the absolute worst way a business can respond to a bad review? Well, today we're going to look at a case that might just take the cake. This isn't just a story about some bad customer service. Nope. This is a huge lesson in data privacy, federal law, and just how high the cost of getting it wrong can be.
So let's start with the situation that I think we can all pretty much relate to, right? A customer leaves a less than flattering one-star review online. If that's your business, what's your next move? What do?
You could apologize. You could, offer to make things right. Or you could do what this one company did and give us a perfect textbook example of exactly what not to do. This is a true cautionary tale, folks.
All right, let's get into it. Our story kicks off with a simple negative review and then an act of retaliation so extreme, so over the top, that it actually triggered a full-blown federal investigation. So the company right in the middle of all this is Mortgage Solutions FCS, a mortgage broker. When they got hit with some unhappy customers on Yelp, they didn't just argue back in the comments. No, they retaliated. They took their customers' private, incredibly sensitive financial information and posted it publicly for the entire world to see.
And I want to be clear, this wasn't just minor stuff. We're talking about sources of income, credit histories, tax info, and it gets worse. They even posted intensely personal details about people's family relationships and health issues. All of this was just lifted directly from loan applications and credit reports, and then bam, plastered online. It was a complete and total breach of trust.
So what made this so illegal? I mean, it wasn't just a bad look for the company. It actually violated multiple federal laws that are specifically designed to protect you and me. Let's break down the exact rules they just decided to ignore.
First up is something called the GLBA Privacy Rule. Now, this is a huge deal in financial privacy law. It was created to give consumers, people like us, way more control over our personal data. It basically forces financial institutions, and yes, that includes mortgage brokers, to be crystal clear in a privacy notice about how they're collecting, using, and sharing your information.
And this is where the deception just becomes so obvious. I mean, look at this. Their own privacy notice claimed they only collected social security numbers and that they didn't share data. But what they actually did, they collected a massive amount of sensitive info and then shared it publicly. It's a total contradiction.
And the violations did not stop there. They also broke the GLBA Safeguards Rule. Now, this rule isn't about promises, it's about action. It requires companies to have an actual written-down security program to actively protect customer information from all kinds of threats and breaches.
This timeline really puts their negligence on full display. The company started up in 2012, but they didn't even bother to create a written security plan until 2017. That's a 5-year gap where they were operating and actively leaking customer data with absolutely no formal security plan in place. It's wild.
And the plan they finally wrote in 2017? It was completely inadequate. It was pretty much just a piece of paper. It was missing the most basic, required stuff, like risk assessments, any kind of testing. They didn't even name a single person to be in charge of compliance.
On top of all the GLBA stuff, the FTC also found they broke 2 more major laws. The Fair Credit Reporting Act, because they used info from credit reports for a totally illegal purpose, which was public shaming, and the FTC Act itself for, engaging in deceptive and unfair business practices.
So at this mountain of violations, what was the real-world cost? Let's get into the penalties and see the actual price they had to pay for this massive breach of trust.
The first consequence was, of course, financial. A civil penalty of $120,000. And while that's a pretty hefty sum, believe me, the penalties did not stop there.
Honestly, in a lot of ways, these other requirements were even bigger. They were legally ordered to stop lying about their privacy practices and to build a real security program. And here's the kicker. They now have to pay for independent audits every 2 years to make sure they're following the rules. Plus, they had to appoint a senior manager to oversee the whole thing. We're talking about long-term, expensive, and constant oversight.
Okay, so what can we all take away from this disaster? Well, this FTC case gives us a really clear roadmap for what every single professional who handles sensitive data needs to know. Let's just walk through the 5 key lessons here. First, know the law. It's not optional. Regulations like GLBA are there for a reason. Second, be transparent. Your privacy notice has to actually match what you do. Third, and this is the heart of the whole story, never ever retaliate by disclosing customer information. Fourth,
You have to safeguard your data with a real tested security program. And finally, number 5, uphold your ethics. This is about so much more than just rules.
At the end of the day, it really all comes down to this. Being compliant isn't just about checking off a box on a form. It's a fundamental, professional duty to protect the people who are putting their trust and their most sensitive information in your hands.
Which brings us right back to that first question. When you're staring at a negative review, the real question isn't just, how should I respond? It's this. Is a 5-star rating really worth destroying the absolute foundation of your business, your customers' trust? As this case makes painfully clear, the answer is a definite no.